The cost-benefit principle states that the cost of providing a particular piece of information in the financial statements must not outweigh the benefit of that information to the users. When a company collects information for its financial statements, costs are incurred. The more information that's collected, the more time and effort are required to do the collecting, and this costs the company and therefore its shareholders money. But sometimes it's not worth collecting information about an account. Let's take the example of a multi-billion-dollar company like Apple. They want their financial statements to be as accurate as possible, and this includes keeping track of assets such as office supplies. Imagine this multi-billion-dollar business buys 100 of these pens, and each of these pens costs $1. Well, these pens are new and still in their packaging, they're worth full value, $100 worth of $1 pens. But by the end of the accounting period, many of the pens will have been used and thrown away. And so they should also be removed from the company's lists of assets and classified instead as an expense. If the accountants at Apple insist on keeping perfectly accurate records, then they could hire a worker to watch the pen supply and track the number of pens used and unused over an accounting period. This worker would watch as each new pen is taken from its package, used, and then discarded. And they would then move $1 from the pen supply account to the pen expense account. Now, even at minimum wage, the salary of this worker would cost the company and its shareholders tens of thousands of dollars. So the cost to the shareholders of gathering perfect information on this one item far outweighs the benefit that they'll get from that information. So in short, some financial information is too expensive to produce. The cost-benefit principle states this by saying the cost of providing a particular piece of information in the financial statements must not outweigh the benefit of that information to the users.